So why is asset demand inelastic? This is with Jay and Mayar, who are sitting right there, and they will serve as reinforcements during the questions. So just basic motivation. John Cochran was trying to remember the shape of the supply and demand curves yesterday. So let's just what is a demand elasticity? Okay, so demand elasticity means that when prices fall by 1%, it's how much an investor increases their holdings by. So demand elasticity of 10 means that when prices drop 1%, the investor increases their shares demanded by 10%, okay? And the relevance of this, and I'm going to talk about this in a second, is that the demand elasticity is 1 over the price impact from flows. And we often think that flows matter, okay? So the problem we're talking about today is that demand elasticity from classic multi-asset models is very, very high. So if you do a classic calibration, you're getting to demand elasticities on the order of magnitude of like 7,000, okay? But estimates from the literature, which directly estimate demand elasticity from holdings data, or sometimes estimate price impacts from different kinds of flow shocks, are closer to like 2. And you want to think these are just ballpark numbers, okay? Maybe 0.5, 2, around there, okay? And so just as a super simple motivating example, I think there's lots of reasons to care about the shape of the demand curve, but let me give you one, okay? So super simple motivating example, let's say the efficient price of an individual stock is at $100 a share, and then there's some 10% outflow for non-fundamental reasons. For example, ESG reasons, behavioral reasons, etc. Okay? Our workhorse, CARA, CRA, and Epstein-Zinn utility models would drop the price only by 0.1 cent. Okay, so essentially these flows just don't matter. The elastic investors just completely absorb the flows and nothing happens because of it in terms of prices. But if elasticity is 2, now the price falls to $95. Okay, so now there's a 5% discount to the efficient price, whatever that means. And this is not a straw man, okay? There are definitely models out there where the authors are arguing that flows don't matter. They're completely arbitraged away. They're completely traded against by the elastic investors, okay? So today we're going to be talking about what explains this really large gap, okay? So the goal is to reconcile these two things. And the point of the paper is explained in this one slide, is that we're going to give you a decomposition, an approximate decomposition, where the demand elasticity equals 1 times something called the price pass-through and something called the weight responsiveness, okay? Just right now, just think that there's these two terms, okay? And what we have in the paper is that we're gonna give you this theoretical decomposition, and then we're gonna estimate both of these parts. And what we're gonna have is that when you plug in realistic price pass-throughs, we're gonna start with a demand elasticity around 7,000. And when you plug in reasonable price pass-throughs, we're gonna get down to about 200, okay, ballpark. And then when you plug in reasonable weight responsiveness, you're gonna get down to around 14, okay? And so that explains most of the gap. And there's this remaining gap that's not the point of the paper, and we'll talk about a little bit later. So the point is, even with sort of rational arguments, you can get down to much more inelastic demand as long as you're plugging in reasonable numbers in this. Okay? So again, empirically observed demand elasticity is not too low. It's actually fairly reasonable. Okay? So I just want to say what we do in this paper and what we do. Okay? This is a demand system asset pricing paper. But actually, we are not estimating demand, okay? I am not going to give you a new price instrument, okay? We're not even using holdings data today. What are we going to be doing? I am just simply going to be taking the perspective of a hypothetical mean variance investor. Now, we're taking mean variance investors, okay, because as Annette said, this is not the behavioral session, okay? So we are going to hug a mean variance investor all the way until we have to get divorced, okay? So, but we're going to hug it all the way to the end. And we can actually go pretty far with that. Okay, so, there's 2 questions. I want to give you intuition for our decomposition. What is the intuition? So imagine you're an investor, and stock I, the price falls by 1% for non-cash flow reasons. So look at this graph here. Let's say we're standing at T, and we're looking at T plus 1, whatever that period is, okay? And we have some expected returns. Just don't worry about dividends for now. Just take this super simple idea. Okay, so before the price movement, this black dotted line represents the expected return. And then the price is going to fall by 1%. And what's the first question we want to answer for our decomposition? Well, it turns out that if you care about the demand elasticity of bananas directly enter into your preferences, into your utility function, and you care about them through that. But in the demands, in classic demand for assets, you don't care about the assets per se. You care about the expected return and the risk that they deliver. Okay, so the first order effect is the expected return. And what we care about is how the price changes and how that price change predicts differences in expected returns. So what we have here is that the expected return is affected by this price drop, but it doesn't completely resolve in this t to t+1 period. Now, if it's long enough gap, it's going to resolve because that's a definition of a non-fundamental price movement. But over a short enough period, it might not resolve. And what we care in the demand, in the decomposition, is ultimately the rate at which it resolves. Okay, so think about this as a DT element. It's the rate at which price movements resolve that matters in our decomposition. Okay, so mu is the expected excess return of the asset, and P is the price. Okay, and then the second part of our decomposition is really how substitutable the asset is. Okay, so it turns out in mean variance demand that if an asset has a good replicating portfolio from the other n-1 of assets, then what you want to do is you want to go long the asset and short the other n-1, assets, the replicating portfolio. And if that's a really good substitute for the asset, then it's nearly an arbitrage. And actually, that's why we get to demand elasticities on the order of magnitude of 7,000, is because a price change is essentially an arbitrage. Okay, and realistically, it's not. Okay, so this is our decomposition. And what we have here is Q is the number of shares demanded. It's, of course, in log terms to be percentages. P is the price of asset I in time T. And we have this decomposition, which really just comes from the chain rule. And what are the two terms? Well, it's the price pass-through. It's how a change in the change in the price changes the expected return. Okay, this is, you want to think about this as in a predictive sense, right? And then you have another term right here, which is how a change in the expected return changes portfolio weight. So how we change our log of portfolio weights, again in percentages, with respect to changes in the expected return. Okay? And we're gonna take the mean variance case. In the mean variance case, the decomposition is exactly the same, except that furthermore, we get this nice term here. So the weight responsiveness becomes 1 over the unspanned return. What is it? Well, if there's n assets, again, this is the expected excess return of the asset. This is the beta with respect to the n-1 other assets. And this is the expected return of those n-1 other assets. Okay? So we're going to measure both of these in the data. If this number is relatively small and the unspanned return is large because it's in the denominator, then you can get to inelastic demand. And that's really the paper. Okay? So we're going to estimate these two terms in the data. And this is going to sort of argue that demand elasticity, even of these sort of hyper-rational friction-free investors, actually delivers relatively inelastic demand. Okay? And it's really, again, about substitutes and how much the price passes through to expected returns, how the rate at which things resolve. Okay? So let's estimate both of these things. So what I'm going to do is I'm going to take a model where I'm going to write the expected returns as a function of characteristics. We do this other ways too to control for fundamental price shifts, okay? And we're going to use a Ladois and Wolf covariant shrinkage method. We're going to use daily data to get as precise as possible. And we use different shrinkage parameters, doesn't matter. Today, what we're going to be talking about is just sort of monthly rebalancing. We can actually look at longer horizons as well, and if anything, the results strengthen, okay? But let's just use monthly stocks. Let's use the largest stocks so that we have this sort of inelastic demand, even for the most liquid stocks out there, okay? So the first component of the decomposition is price pass-throughs. What we're going to do is we're going to run Fama-Macbeth regressions on a bunch of price-related characteristics. So for example, we're going to run, estimate, returns on the left-hand side, and on the right-hand side, we're going to have the previous returns, market equity, and book to market equity, okay? And when we do that, we have a monthly price pass-through of 0.02, okay? And then when we include other controls that are characteristics that are not a function of prices, we get a monthly price pass-through of about 0.03, okay? This is at a monthly rate, okay? And so what we have is something much smaller than 1, but static theory models, which people use static theory models to infer price impacts. Static theory models, of course, by definition, resolve at the end of the model. And so the price pass-through would be 1 for a static theory model. But even dynamic models, other authors have argued that even lots of dynamic models still price changes resolve relatively quickly. Okay, they're mostly short-term discount rates, But in the data, a lot of the price variation is in long-term discount rates. Okay, so using a dynamic model in no way fixes this. Okay, it doesn't necessarily fix this, is what I mean. Okay, we're going to estimate unspanned returns. So here's the graph right here. I want you to think about this. This is a bin scatter. Okay, on the x-axis is the expected excess return of different stocks in the cross-section. And on the y-axis is the spanned excess return. Okay, so this is beta times mu. This is the replicating portfolio of all other excess. And if, you know, in most multi-asset theory models, if you run a calibration of this, what you have is something very close to the 45-degree line. Okay, so an asset that has a higher expected excess return also has a higher spanned excess return, okay, from the replicating portfolio. And because this is in the denominator, this leads to very large demand elasticities. So but when we measure this using our Ladois and Wolff method, what we have is this estimated curve. So this red curve right here, and the gap between these two is the unspanned return. Okay, so that's what matters in our decomposition. And the portfolio weights are positive above this line right here. And this is what we're going to look at because demand elasticity is only defined for assets with positive weights. Okay, and actually, if you extend the definition of demand elasticity to negative, you get similar results. Okay, but what we have here is the positive portfolio weights, and it turns out that about a third of the return is unspanned. Okay, so this is about a third in terms of the wedge. And when you plug this into our decomposition, you get relatively inelastic demand. So let me do that right here. We start with a demand elasticity of about 7,000. Then you plug in reasonable price pass-throughs of about 0.03. Okay, and that gets you down to a demand elasticity of about 200. Okay, and when we plug in our reasonable estimates of unspanned returns, unspanned excess returns, this is about 1 over 0.23%. This is again a monthly rate. Then we end up at demand elasticities of about 14. And so the takeaway of this graph is that we explain multiple orders of magnitude just by doing this exercise. Okay, so we explain most of the gap. Now, a lot of people may worry that we're not doing a good job of controlling for fundamental price movements. And what we do is we do this decomposition where P tilde here is a cash flow based valuation. So it's really future expected discounted cash flows. And then here, P divided, you know, the log of P divided by P tilde is purely discount rate related. So we're going to rely on these authors' decomposition in order to control for fundamental value and see how much price pass-through that is only related to discount rates, how fast that resolves. Okay, again, we're going to run Fama-Macbeth regressions. And in this first row, in the first column, we have a price pass-through of about 0.014. Okay, so even lower than our 0.03. We can estimate this at longer horizons. It's important to realize that when you estimate this at longer horizons, so right, the price pass-through does resolve eventually for a longer horizon, but the unspanned return also grows. So again, it's really the rate that matters. And so when we estimate this for longer horizon, sure, some of these are resolving more. So the price pass-through at the yearly horizon is, you know, 0.16. But when you scale this back to monthly, because again, the unspanned returns are growing, again, you're not getting above 0.03. Okay, we're going to use another price wedge, and we're going to use two instruments related to the literature. For time's sake, I'm not going to talk about this, but a lot of people have the strong intuition that some of these instruments are going to lead to price variations that resolve more quickly, and that is not necessarily the case. And that doesn't mean that these price instruments are bad. Okay, matter of fact, I use some of these in other papers. Okay, but it just means that they don't necessarily resolve faster than sort of the average price movements that we are estimating early. Okay. The second part of the robustness is just to estimate the unspanned returns in a bunch of different ways. Okay. So we're going to use, you know, instead of characteristic-based Fama-Macbeth regressions, we could do factor-based Fama-Macbeth regressions. We can use rolling regressions. We can do everything out of sample. We can use different parameter shrinkage approaches. We can use characteristic. We can use covariance matrices that are estimated with, you know, characteristics like BARA. Okay, we can do a bunch of different methods, and the results are actually quite similar. Okay. One question that we get sometimes is that a concern that maybe high unspanned returns leads to Sharpe ratios that are unrealistically high, okay? And that's not really the case. So the Sharpe ratio of our mean variance strategy is about 1.3. This is consistent with multi-factor models, okay? And why is this? We have this decomposition where the maximum Sharpe ratio squared equals this quadratic term with a vector of unspanned returns. And there's also this D matrix. And what is this? Well, it's a diagonal matrix with 1 over the unspanned variance along the diagonal. The unspanned variance is just a very similar term where it is the variance of the asset that is not explained by the n-1 other assets. And it turns out that if unspanned variance is high, then this offsets some of the unspanned returns so that you get inelastic demand, but Sharpe ratios that are not too high, okay? And again, that even with mean variance weights, which are sort of, we all know, are kind of all over the place, they're super sensitive. I think of them as fairly sensitive to prices compared to what we see in the data. You still have surprisingly inelastic demand, at least surprising for us, okay? So now I want to talk about the remaining gap. So the demand elasticity is the price, price pass-through plus weight responsiveness. And there's potentially other terms like variance, covariance effects, Epstein's-in, hedging, okay, wealth effects. And every time we've looked at this, the results are just not very large. I'll talk about that in a second. But what I want to spend a second on is the weight responsiveness. So we still have the case that if the expected return increases by only 1 basis point, in our baseline calibration, you still increase dollar holdings by 4%. Okay, it's still very responsive. So we think that mean variance demand is still, very responsive to changes in expected returns. And if you believe the demand elasticity is about 2, then this needs to fall from a 4% increase to about a 0.3% increase, which is perhaps a more reasonable number motivated by the data. And so there's maybe other things. We're not going to take a stand on what are the other things we need to get down to the reasonable numbers. But we can talk about short sell constraints, trading costs, behavioral effects, other things that maybe get us down there longer. But we wanted to see how far we can go just with mean variance demand. Okay, so let's talk about other terms right here. So this is our main decomposition. And you could also include potentially covariance effects. Some of these could come through idiosyncratic volatility. Right. And some of these could come through sort of like beta effects, so changes on the loadings of systematic risk. It turns out that this is maybe in the ballpark of about 2, okay? And this is about in the ballpark of like 1, if that, okay? And so it turns out that the other terms in our decomposition don't seem to matter very much empirically, okay? And we also do an Epstein's-in hedging. So we take multivariate Epstein's-in, like Campbell and Viceira, sort of Epstein's-in, multi-asset Epstein's-in. We estimate how much consumption hedging would affect the elasticity, and it's not that much, okay? In my last few minutes, I could talk about applications of our decomposition. So I have another paper. I talk about the statistical arbitrage demand elasticity and how it's relatively inelastic. In this paper, I look at 13 statistical arbitrage models. And across all of these, this is even when you throw sort of machine learning at it, if you do optimal shrinkage, you throw sort of everything at it you can across these 3 different models. I get inelastic demand across all the models, okay? And there's a bunch of richness in the paper that I can look at. So I can look at sort of the elasticity of betting on alpha strategies. I can look at systematic versus idiosyncratic elasticity. But at the end of the day, I make the case that it's hard to trade against price variations. And this decomposition helps us to look at this. So we can see that mean variance demand, if you have this unspanned return that's relatively large, then it helps us realize that substitutability is hard. Okay, so price changes don't resolve quickly, and it's hard to find good substitutes, and that's what leads to inelastic demand. Okay, that's really the pitch of the paper, and this gives some insight into this paper. Now, in most of these models, you can't separately decompose these terms. And so what we do in this paper is we take a model where we really can separately decompose these 2 terms. But in lots of factor-based models, you really cannot tell what is coming through this or coming through this. And the point of this is a simple decomposition that sheds light on this. Despite the title of the paper, we're not making the claim that demand is inelastic for all assets in all periods of time, no matter what, okay? So other authors have argued that demand elasticity can be high, for example, with short-term investment grade bonds or something like this. And this is actually completely consistent with our decomposition. So for these kind of things, you would expect higher pass-through, and you would expect fairly good substitutes if it's investment grade. And so perhaps that's reasonable. So we're not sort of fighting against these other authors. And we also want to point out that we are just making claims about the average elasticity of a mean variance investor. Okay, that's really the paper today. You'll notice that in some of our assets, the unspanned return is very, very low. And so the demand elasticity is very, very high. Okay, and that's entirely fine. What we're making statements about is average elasticity through time. And so we're not making the claim that demand elasticity, demand elasticity, according to our decomposition, is not a primitive structural parameter. These are something closer to the primitive structural. I'm out. Okay, so in summary, there's two things that lead to inelastic demand. There's two things I showed you in our decomposition.